It's nice to see a good turnout. There's lots more people who registered. Whether they come or not will have to remain to be seen. Many of you will know the format of these evenings. We will ask our speaker, who I'll introduce in a moment, to talk for between 30 and 45 minutes, and then we'll have questions and discussion. And then when we run out of steam, we will adjourn upstairs for a drink and further discussion there. And I'll on that part of the evening when we get to it. But easily the most important part of the evening is this talk that we're going to have, Unburnable Carbon 2013. Many of us have seen that publication, of course. And it was really burst on the scene, this whole issue of wasted natural capital. What are the economic implications of either using or not using natural capital is becoming an increasingly hot issue, and one in which I must say the Institute of Sustainable Resources is keen to make its mark. So I'm busy exploring all sorts of opportunities whereby we can get active in this field to supplement the excellent work that's being done by Carbon Tracker. James Lee was due to be here as well as Luke, who is here. Unfortunately, he's ill, so he can't come. But I've said that I'm sure Luke is going to be able to deliver what needs to be delivered. He's a researcher at Carbon Tracker. He leads on Australia and Brazil, two pretty important natural capital places, and he's co-authored the Wasted Capital and Stranded Assets report. He's lectured at the Smith School, and many of you will know that Ben Caldecott of Climate Change Capital has gone to the Smith School to work on the whole stranded assets issue, and has presented Carbon Tracker's research to the Foreign and Commonwealth Office. He's on the advisory group of the Heinrich Böll Foundation, and he's yet another one of these people who got an MSc in Environmental Technology and Material. I was counting all the people I've employed who come out of that excellent MSc, it would be a long list. It's not as good as our It's been going slightly longer than ours. So Luke, enormous pleasure to have you with us. Much looking forward to what you have to say.
Thank you very much, Paul. Yeah, if I can echo those apologies from the rest of the Carbon Tracker team who couldn't make it. Our founding director, Mark Campanale, was originally supposed to speak with me, but he's now been whisked off to Davos to talk to incredibly important people about this issue. And James was very much a last-minute illness. So you're stuck with me, I'm afraid. And so I'm going to be talking about some of our research going forward, and also some of the market signals that we see are helping support a lot of the work that we've been doing. For those people who are unfamiliar with Carbon Tracker's work, a very brief overview is that essentially our first unburnable carbon analysis, our first global analysis, was released in 2012, which first approached the contradiction between the fossil fuel companies listed on the world's capital markets, on the world's stock exchanges, and the messages we were getting from climate change policy and governments around the world. To look at who we are further, I mean, here's our mission: to change the financial system to develop climate security. Our team, although it's only Mark, James, and myself who are full-time, we've recently announced that Anthony Hobley will be starting as CEO at the beginning of next month, which is incredibly exciting. Some of you may know him, who heads up or used to head up climate change at the law firm Norton Rose Fulbright. And then our chairman is Jeremy Leggett, the founder of Solar Century. Here are some of our funders that help us achieve what we've done so far. 2013 was a relatively prolific year for us. Aside from the Wasted Capital and Stranded Assets report that I'm here to primarily talk about, we released these 5 reports as well. On the right and on the left. On the right is Australia's report, on the left is Brazil's, as Paul said. We started to undertake some regional analyses to look at specific geographies and some of the issues that are most prevalent in those, and which surround sort of the issues that we talk about with unburnable carbon and the carbon bubble and stranded assets. We've also done reports on sort of key flagship projects that they're incredibly high profile, such as Keystone XL. And we worked with Standard & Poor's, the ratings agency, on some of the possible impacts of carbon constraints on oil sands development, and then the report in the middle was in association with ACCA and looking at some of the reporting and accounting processes, specifically around fossil fuel reserves, which are obviously integral to our narratives and our analysis. So to look more specifically at the wasted capital report, we did it with the London School of Economics and Lord Stern's team. And this is what Lord Stern said about the report. He said, "This report shows very clearly the gross inconsistency between current valuations of fossil fuel assets and the path that government have taken to manage the huge risks of climate change." Very nicely sums up the fundamental contradiction at the heart of what we're investigating. And at Carbon Tracker, we were very happy with the media take-up of it, as it was featured on the front page of The Guardian, and most major publications in the UK and on the other side of the Atlantic in the US. So, at the heart of this research was this diagram, essentially. We tried to simplify it as much as possible, and we tried to simplify the capital flows on which fossil fuel companies are reliant. And this is what we came up with. Obviously a relatively difficult task, but in a very simplified form, this is what we said. Now, we asked the question, what happens if you put a question mark next to this bit in black? If you put a question mark and the ability to develop and consume and burn fossil fuel reserves. If you put a question mark on that section there, what does it do to the other capital flows, which are highlighted in the diagram, upon which these companies rely? Are they able to pay off their interest? Are they able to pay out dividends? Are they able to raise debt? And we'll come back to this diagram in a bit when I make a big grand unveiling of the figures alongside each one of those arrows. And to do this, we used carbon budgets, an approach which has been taken on by a number of the major institutions worldwide. The IPCC, obviously in their latest report in the AR5, utilised this approach. The IEA before that had also used this approach. Now, using carbon budgets can be a slightly complicated process, and unfortunately a number of people do get it wrong, which is relatively detrimental to sort of the clarity and the coherence of the message that we're trying to get across. Now, in this table here, we are looking at purely the IPCC scenario from the recent AR5 and the pessimistic carbon tracker scenario, which is the scenario which we like to call that used in our first 2012 report. Now, that 2012 report used the Potsdam Institute's modelling. The one which we call optimistic is the most recent one, the Wasted Capital and Stranded Assets report, which used the model of the Grantham Institute at LSE. Now, obviously you can see there's a lot of different numbers here, and we need to sort of focus in on those that are most important. At Carbon Tracker, we like to focus in on that with an 80% certainty of being able to keep within 2 degrees C. We'd like to not risk the entire future of our climate security on a 50-50 coin toss. So 80% is the one which we focus on. And as you can see, that if we're looking at just the 2012 to 2050 time period, you see that this carbon budget ranges between 500 gigatons of carbon dioxide and 900 gigatons. Now, this is an issue which a lot of people, I mean, the vast range is an issue that a lot of people sort of struggle to get their heads around, and deem to be a weakness in our methodology and the message that we're trying to get across. But as many will know, that dealing with climate science is a very complicated issue, and there are a number of different variables upon which there is uncertainty. Just a few here, on which the assumptions which the Potsdam and the LSE Grantham model differ, were, for example, the level of aerosols and the reducing warming effects. By burning fossil fuels, it releases aerosols, which actually have a net cooling impact on the atmosphere. The efforts to mitigate and the successfulness and the efficiency of mitigating the non-CO2 emissions. These are just CO2 budgets. So if you're more successful in reducing methane from waste and agriculture, then the budget available to just carbon dioxide will obviously be larger. And as a third one, you're looking at the probability, as I mentioned. I mean, and the IPCC report kind of added to the complexity of dealing with carbon budgets because their budgets went out to 2100. They didn't actually run an 80% probability scenario, and although the decreases which are associated with the various probabilities they did do it for allows you to make a prediction like we have here, obviously if they'd run the numbers themselves it would have been more useful. Other varying factors upon which carbon budgets vary are also climate sensitivity and whether or not it includes land use and land use change and forestry. So anyway, after all of that, we want to sort of stick to the number 500 to 900 gigatons of CO2. This is the range in which we're dealing. Now, this is an indication of exactly the contradiction which we're dealing with. Here are the various carbon budgets that I've just sort of explained, out to 2100, mind. And that is the size of total global fossil fuel reserves. And that's 2,860 gigatons of CO2. Now that includes listed and state-owned fossil fuel reserves. But you can see that between 60 and 80% of global fossil fuel reserves aren't burnable to keep within a 2°C world. Maybe now is a good time to define fossil fuel reserves. Reserves are those coal, oil and gas assets that the companies have at least a 90% certainty that they will be proven economically viable. Most coal, oil and gas companies just book the whole lot. They assume that this will all come online, it's all economically viable and it's all burnable. So, if we compare that budget against the IPCC emissions scenarios that they ran, RCP 2.6 is essentially their 2 degrees scenario. RCP 8.5 is a business as usual scenario. You can see that if we continue the way we're going with the most stringent carbon budget, that we will in fact blow through the 2 degrees budget within 18 years, although now we're in 2014, it's 17 years. And the 2 degree scenario obviously buys us quite a bit more time, but both are saying to us that we need to start acting now.
What year was that?
The other one was 2045, or the first one, 2031. But at Carbon Tracker, we focus on the listed companies. We focus on those companies in which you and I have capital invested, that pension funds are invested, in which we hold a stake. And so we analyze the top 200 companies, coal, oil and gas companies listed on the World Stock Exchange. Now, listed reserves only make up a quarter of the global fossil fuel reserves that I mentioned before, the 2,860. So if you allocate a pro rata carbon budget, so a quarter of the budgets that I was discussing previously, you will see here that sort of indications of what the budget might be for 2 degrees, 2.5 and 3 degrees. So these are pro rata budgets for just the listed companies. In this latest Wasted Capital and Stranded Assets report, not only did we look at fossil fuel reserves, but we also looked at fossil fuel resources. Now, resources are those that are defined as having at least a 50% chance of being made economically viable and proven. So they're more speculative assets. They're those that the companies are working and spending billions upon billions to prove and bring online. So the listed reserves total 762 gigatons of CO2. The listed resources double that and go to 1,541 gigatons of CO2. These are only the 200 top coal, oil and gas companies globally. So you'll see the mismatch is quite stark. And something that I always like to highlight in this diagram is that one of the arguments that we get pushed back on a lot is that 2 degrees isn't realistic. So we might as well go to target 2.5 or 3 degrees, a more realistic global climate change limit. But what these carbon budgets are showing is that once you break through the 2 degrees budget, going to 2.5 or 3 buys you very, very little more time. So it's not a wonderful argument, though we feel anyway. Also, one thing that I haven't got a slide on, but we also ran in this report, was the impact of CCS, which is carbon capture and storage. Something that a lot of people also talk to us about, and something which the fossil fuel companies themselves like to highlight as something that they're investing grave sums of money into, and that will hold the future, hold the sort of the security of our climate future. And in our scenarios, we use the IEA's most optimistic scenario, the one that assumes full investment, the maximum investment possible. And the contribution of CCS to 2050 was only equivalent to 4% of total global fossil fuel reserves. So what did we do with this information? Well, this is how we make it up. I mean, this is how we work it out. And so coal, oil, and gas reserves, we simply times by a CO2 factor, which gives you the CO2 potential of that company. You add up the sum of those CO2 potentials per company, and it gives you the total for the exchange. You add up the exchange totals, it gives you the global total. It really is very, very simple mathematics, and therefore that's something which we like to highlight to the companies themselves as a reason why they should disclose this information. Because it's not going to cost them anything. It's a very, very simple multiplication exercise. So what we did with that information then is we mapped it globally. And we found that there are 3 major centers for fossil fuel reserves. There is London, there is Moscow, and there is New York. Now, London, we're relatively fortunate. We seem to have quite a lot of coal and quite a lot of oil. So we have hedged our bets across the fossil fuels. New York is the center for oil, certainly, and is by far and away the most exposed to CO2 assets. We may not try and target Moscow quite yet. Now, when you map potential the potential reserves, the fossil fuel resources that I mentioned earlier, you will see that obviously everything goes up. London actually overtakes Moscow in terms of the scale of those assets. But one thing which is slightly concerning is that of the total, the proportion allocated to coal actually goes up. So coal is a more CO2 intense fossil fuel, but its proportion of the total of those assets that could potentially be coming online and that companies are spending grave sums of money to achieve is actually more CO2 intense than those that are currently proven. So we go back to this diagram and we fill in some of the blanks. And the figure that we like to focus on at Carbon Tracker here is this 674 billion of capex. This is the capital that these 200 listed fossil fuel companies are spending each year to try and prove those fossil fuel resources into fossil fuel reserves. So this is the $7 trillion question over the next 10 years that we're trying to assess, that we're trying to tackle, and we're trying to realign, essentially. So this report revealed these conclusions to us, that markets are based on a 6-degree trajectory, that investors are tied into these markets, and that they're perhaps not aware of exactly the path in which their capital is leading us. That the markets are not responding to climate policy, and that this is a systemic risk. And we're trying to, at Carbon Tracker, we're trying to tackle each one of these different stakeholder groups, each one of these different components of the capital markets and this systemic risk. And there are a number of other organizations now which are coming on board to help, which is great considering we're only 3 people. So that was the first stage of our analysis, and now moving into 2014, the question has changed, and the question has now become, okay, well, we know that there is the risk of asset stranding. We know that there is climate risk and that high carbon assets are potentially more risky to carbon constrained futures than others. But which of those assets are most at risk of stranding? And what does this mean to the fossil fuel companies? It's the next level of granularity that we now need to go into. And in a carbon constrained world, funnily enough, it turns into almost a fight between the fossil fuel companies, with coal versus oil versus gas. And that's a future that we would be very happy to see. So what is most exposed? Well, the IEA says that coal is most exposed. As I said, is the most CO2 intense of the 3. That is a relatively logical assumption. As they say here in this report from the middle of last year, only 20% of global coal reserves can be developed by 2050 without CCS. And as I said before, I think some of the prospects for CCS aren't looking perhaps as optimistic as many might hope them to be. So that's probably quite a good guideline to take. And a number of the different investment banks are actually coming on side. And I mean, Citi Research here was actually perhaps the most forthright of the three, saying that peaking of thermal coal demand for power generation in China may be by as soon as 2020. Now this poses a big problem for the fossil fuel companies, and also those financial institutions involved in the rating of those companies. Because are they really preparing for that future? China makes up such a significant proportion of the demand for coal globally now. Are they planning for that? And are they able to explain to their shareholders how they are compatible with that future? How their business model is still viable in that future? And something at the top here, which I think is really important about a lot of what we do, and is especially pertinent with regards to coal as we're seeing in China, is that these sorts of drivers and these sorts of triggers don't have to be packaged up as carbon. Air pollution and water scarcity, which are both key issues in China, especially air pollution, which they are moving incredibly quickly on, have exactly the same effect. The simple dynamics of demand and price mean that those triggers will actually have a very similar impact, which I think I do go into in a bit. But then to look at oil and gas, HSBC have run analyses of what a lower oil demand future might look like. Now, a lower oil demand future could potentially take down the price of oil to $50 US. This was the scenario that they ran. As a lower demand obviously equals a lower price. And what they found was that price risk is a very material risk, and that it could potentially impact up to 60% of current market cap of these companies. Now, to me, that's an incredibly material risk, and it's also an incredibly grave risk to take if you're not running those numbers yourself, if you're assuming that that won't happen and you're not hedging against it. I know that UCL did their own paper, which came out in Energy Policy Journal recently, and specifically on unextractable, unburnable oil. So I included this carbon budget, which is specifically for oil assets, which the Norwegian Petroleum Fund actually commissioned this research. Now, the Norwegian Petroleum Fund is an $800 billion sovereign wealth fund and the biggest in the world. So the fact that they're commissioning this research, and potentially we hear actually thinking about selling out of coal, is incredibly significant. But under an estimate where they have the highest coal reductions and therefore the largest possible budget available to burning oil assets, which then equaled 435 gigatons of CO2, 22% of those oil assets which are being planned to be brought online still become stranded. Now, I think what's interesting here is that it's split between those assets that are already discovered and those that are not yet discovered. You might assume that everything that they know about already, i.e. the discovery bar, would be burnt and consumed before those that haven't been discovered yet. But it's not, that's not how it works. It works in terms of whether or not it's economically viable or not, and which are more economically viable than others. And I think that's what I look at here, in that this is a cost curve of 300 of the largest oil projects globally, which Citi did. And if you take the oil price, which HSBC ran their scenarios against, and apply it to this graph, you'll see that when the $50 break-even price for oil comes across, anything above that line then becomes at risk of stranding. And this is HSBC and Citigroup who are talking about this. So what we see here is that unconventionals fall off the top. Anything at the top end of this cost curve is most at risk of being stranded. And something we're seeing more and more of now in the oil and gas industry is that they're experiencing almost an existential crisis, because capital spending, CapEx, to get out the same amount of oil is going up and up and up. The easily extractable and easily most commercially extractable oil assets have become more exhausted than they were previously. And we're moving more and more towards unconventional oil, and CapEx is going up and up to just extract the same amount of oil. So you have to ask yourself, is it wise for these companies to continue spending this capital rather than handing it back to the shareholders? Now, recent financial results actually proved a sort of paradigm shift in these oil and gas companies, in that a lot of them shed their CEO and hired new ones and instantly said, we're going to cut back our capex and increase our dividends. Now what this will do is boost the share price. So the question then becomes, well, what are the incentives and what are the priorities for those decision makers who have that choice? Is it to continue to keep your reserves replacement ratio high, which was the previous indicator for these companies? If you can prove that you're finding and bringing online as many reserves as you're burning, then that was always seen as a good thing to the shareholders. Is that still the priority? Or is it in fact the level of dividends and share price? And this is something that an oil and gas analyst, Paul Spedding at HSBC, said at the launch of our Wasted Capital and Stranded Assets report. He said, this report makes it clear that business as usual is not a viable option for the fossil fuel industry in the long term. Management should already be looking to new business models that reduce the risk of stranded assets destroying shareholder value. In the future, capital allocation should emphasize shareholder returns rather than investing for growth. And here's a quote from the research that we did with Standard & Poor's. We looked specifically at oil companies and found that the credit ratings that are given to those pure oil sands companies is at risk in a carbon-constrained world. Again, what they said here is that the commercial viability of undeveloped reserves and hence the core business model could come into question unless development costs also fall. It could lead to a potential downgrade. Now we're dealing with credit ratings agencies, accountants, the analysts, the investment banks themselves, as I say, because this is a systemic issue and you have to take it at a holistic level. This is one thing that you could potentially argue is not being considered potentially by the divestment movement that has come out of our research, in that those companies and those institutions that are divesting, is it really a structural change that they're demonstrating, or would those shares just be bought up by other people? And so I think we need to be aware of the issue as a systemic issue to really create lasting change with this. And recently, investors have started looking at exposure. And we teamed up with Ceres, who are an organization in the US, to bring together 70 investors worth over 3 trillion in assets to engage with the 45 top coal, oil and gas and utilities companies globally. And these are what some of the stakeholders involved said. I won't go through them all. But essentially, yeah, institutional investors must think over the long term and take into account these environmental risks. Now we're actually in 2014 looking at these 45 companies in greater detail, examining their capital spending structures, examining their disclosures on climate risk and of their carbon reserves, and also looking at the incentives given to their board and those decision makers at the top of these companies, to inform investors of those issues that we think these companies are most susceptible to, and provide them with the questions which they can go to AGMs and they can start shareholder resolutions on and say, I see that you're spending such and such billion in the Arctic. Do you think that that money might be better spent, handed back to shareholders as dividends? So what do we say are the options going forward, as we say in this $7 trillion question? The first thing we look at, very much similar to the HSBC analysis, is that we recommend that these companies review their valuation assumptions. They run the numbers. They stress test their assumptions. What happens if the 20% probability, and that's an incredibly pessimistic approach, but what happens if the 20% probability that governments take preventative measures on climate, what does that mean for your business model? And can you prove to those to whom you are accountable that you still have a viable business model? As I say, challenge the CapEx plans. Look at the amount they're spending on high CO2, high capital projects, and say to them, is this really the best way for you to spend my money? We also call for enhanced disclosure. We feel that a very material consideration for investors is for them to be able to see the fossil fuel reserves of these companies, and then not only just to be able to understand what their exposure to CO2 assets are with that initial figure, but track it over time to see if they are becoming more or less exposed. That seems a very, very simple disclosure requirement to us. And then obviously it's for the overseeing regulators to address this climate change issue as a systemic risk to the capital markets. A few things said by some of the larger institutions coming on board with this carbon bubble, unburnable carbon and stranded assets narrative. As I say, the IEA also corroborated our findings with their carbon budget analysis, deeming that more than 2/3 of fossil fuel reserves cannot be commercialized in a 2 degrees world. Angel Gurria at the OECD said that we have a looming choice between either stranding high carbon assets or stranding the planet. And Al Gore, who has also got on board with the carbon bubble issue, says that bubbles by definition involve a lot of asset owners and investors who don't see what in retrospect becomes blindingly obvious. And this is something which happened with the financial crisis. A lot of what we're hearing is that, I mean, it was quite interesting in a Citibank report. They said this is unburnable carbon analysis is actually fine. I mean, the numbers are relatively indisputable. But be warned about selling out of these fossil fuel assets too early, because then you may be at a disadvantage. Now that's a really risky approach, and probably the approach that was taken by a lot of people before the 2008 financial crisis. But the problem is will there be a market who you can sell your fossil fuel assets to when the train is running towards the edge of the cliff? The financial crisis, not everyone got off the train. So we're trying to warn against that scenario. And so what are we doing going forward? Here are some of the issues which have come up a lot in my presentation. Yeah, and there's a good summary there. I mean, talking about some of the things that we're doing this year, we're looking at China in a regional approach, in a regional analysis. We're looking at the US. We're taking those markets that are key both in terms of their financial positions as financial centers of the world, but also those that are at the heart of obviously the climate issue and fossil fuel consumption. As I say, we're looking at analyses of those 45 top coal, oil and gas companies. And I think we're doing a bit of work on the utility sector as well, which is, especially in Europe and also in the US, in a bit of an existential crisis as well, in a very changing energy market. As I say again, apologies that James couldn't make it, but if you have any questions that you don't ask now, please feel free to send us an email. That would be good.